Hello guys, this is Shoaib Yaqub. In today's session, we are going to discuss a past exam paper of AFM, previously known as P4. So let's start with the requirement. Compare and contrast the reasons for opinions held by Director A and by the Director B and discuss the types of synergy benefits which may arise from the acquisition strategy suggested by Director B. Okay, this is the A part of this question. In this part, we have to discuss the opinions of Director A and Director B, and then we have to identify the synergy which may be given in this scenario. So we have to discuss the types of synergy benefits which may arise from the acquisition. Okay, in the B part, discuss how using rail options methodology in conjunction with NPV could help establish a more accurate estimate of the potential value of the companies as suggested by the Director C. So it can be seen that there are three directors. Upon the opinions of A and B, there is a part A, and on the opinion of Director C, there is a part B. Okay, both of these parts are easy, these are not technicals. We will discuss these two parts after reading the scenario. Part C, prepare a report for the board of directors of C company, which estimates the current value of FCO, estimates the equity value arising from combining F company with the C company. That means in first part of the C, we have to estimate the value of acquiring company. And in the second part of the part C, we have to discuss about the combined value by combining the target with the acquirer. And third part evaluates whether the acquisition of F company would be beneficial to the acquired company shareholders and discuss the limitation of the valuation method used in C1 and C2. So we have to discuss the assumptions which we have taken, and obviously majority of those assumptions we have to discuss the assumptions of the part 1 and part 2 of the C method, and majority of those assumptions will become the limitation. Professional marks will be awarded for the format, structure and presentation of the report. And D part discuss how the mandatory bid rule and the principle of equal treatment. So these are two requirements. And principle of equal treatment protect shareholder in the event of the company facing a takeover bid. And discuss the effectiveness of the poison pill. This is the defense mechanism and disposal of the crown jewels as defensive tactics against the hostile takeover bids. So this contains 8 marks. So 9 plus 5, 14 plus 8, 22 plus these 7 plus 4. So almost 60% of part of the first question is of theoretical nature, and like 40%, around 40% is of the numerical nature. So let's discuss the scenario first, then obviously one by one we will solve all these parts. Okay, this company is a large listed company operating in the pharmaceutical industry with a current market value of equity 12,600 million and a debt equity ratio of 30:70 in market value terms. That means equity value is 12,600 and debt to equity ratio means debt is 30, equity is 70. Institutional investors hold most of its equity shares. The company develops and manufactures antibiotics and antiviral medicines. Both the company and its products have an established positive reputation. So it is established positive reputation among the medical profession, and its products are used widely. However, its rate of innovation has slowed considerably in the last few years, and it has fewer new medical products coming into the market. So this is the problem. At a recent meeting of the board, it was decided that company needed to change its current strategy of growing organically to one of the acquiring companies in order to maintain the growth in its share price in the future. Previously, company grew through organically, and now the company wants to grow through inorganically. The member of the board had different opinions on the type of acquisition. Director A was of the opinion that companies should follow a strategy of acquiring companies in different business sectors. She suggested that focusing on just the pharmaceutical sector was too risky, and acquiring companies in other different business sector will reduce the risk. So this director is suggesting about that diversification. So there will be a debate here because we know from our basic knowledge that diversification is the role of shareholder, not of the company. Director B was of the opinion that Director A's suggestion would not result in a reduction in risk for shareholders. In fact, he suggested that this would result in agency related issues with company shareholder reacting negatively, and as a result, the company share price would fall. Instead, Director B suggested that company should focus on its current business and acquire other established pharmaceutical companies. In this way, company will gain synergy benefits and thereby increasing value to the shareholders. So Director B is suggesting that company should grow horizontally. It will increase the synergy benefits. Director C agreed that with Director B, but suggested that companies should consider relatively new pharmaceutical companies as well as established business. In her opinion, newer companies might be involved in the research and development of innovative products, which could have high potential in the future. She suggested that using real option methodology with traditional investment appraisal methods such as NPV could help establish a more accurate estimate of the potential value of such companies. Okay, so these were the different opinions of the different directors. The company has asked its finance team to prepare a report on the value of the potential target company, F company, before making a final decision. Okay, F company is a non-listed pharmaceutical company established about 10 years ago. Initially, company grew rapidly, but this rate of growth slowed recently, 3 years ago, after venture capital equity backer exited the company by selling its stake back to the founding directors. Director had to raise substantial debt capital to buy back the equity stake. Current debt equity ratio is very high. This high level of gearing means that company will find it difficult to obtain funds to develop its innovative products in the future. Okay, following financial information relates to the F company. Sales revenue is given, PBIT, interest, tax, profit after tax is given. In arriving at the profit before interest and tax means that profit of PBIT, company deducted tax allowable depreciation, that is 112, and its cash investment, capex and working capital is $98.2 million. 3 years ago, company profit after tax was 83.3 million, and this has been growing steadily into their current level. Company PBIT and its cash flow grew at the same rate as well. It is likely that this growth rate will continue for the foreseeable future. Company cost of capital is 10%. So this information is given in order to calculate the market value of F company. Especially this information is given in order to calculate the growth rate. We will take the latest profit in the numerator, earliest profit in the denominator, and we will take the growth by taking by taking the change in the profit level, and cash flow will grow at the same rate. Okay, what about the combined company? Once acquirer acquires target company, it is predicted that combined company sales revenue will be 4,200 million in the first year, and PBIT margin is given. And after the first year, sales revenues will grow by 7% in the next 3 years, and after 4 years, growth will be 5.6%. This part is quite similar to the previous past paper question Nenteko, and this part is quite similar to the pursuit company part. So if you practice these two questions, you will get the info that past exam paper resembles each other. Okay, the combined company tax allowable depreciation expected to be equivalent to the amount of investment needed to maintain current level of operation. Whenever the statement is given, please read the statement again, and whenever this statement is given, that means there is no need to add back the depreciation because depreciation and capex amount is same. And whenever depreciation and capex amount is same, we will not be adding depreciation because depreciation and capex will cancel out each other. However, as the company sales revenue increases over the 4-year period, combined company will require an additional investment in assets of 200 million in the first year, then 0.64 per year increase in sales revenue for the next 3 years. It can be assumed that asset beta of the combined company is the weighted average of the individual company asset betas weighted in the proportion of the individual company equity values. It can also be assumed that capital structure of the combined company remains at the parent company current capital structure, that is 30/70, and KD before tax will be 5.3%. Parent company, the acquired company estimate that it will be able to acquire target company by paying premium of 30% above its equity value. So these are the equity betas of both of the companies and the asset betas. Obviously, we need asset betas. Risk-free rate is 2%, premium is 7%, tax rate is 20%. And the last paragraph belongs to the last part. Board agreed that in the future it is likely that company will target both listed and non-listed companies for the acquisition. It is aware that when pursuing acquisition of the listed companies, company would need to ensure that it complied with regulations such as the mandatory bid rule and the principle of equal treatment to product shareholders. Board is also aware that some listed companies may attempt to defend acquisition by employing anti-takeover measures such as poison pill and disposal of crown jewels. Okay, in order to solve this question, we need to solve the 4 parts. But first of all, let's solve the third part, part C, the numerical version. Then obviously once we have completed the numerical version, then we will shift the theoretical part. So let's start with the very first part, current equity value of the Fushoro company. Okay, uh, here's the data given of the F company. Okay, in order to calculate the value of the F company, if we read this data, we have come to know that we need to calculate the free cash flow to the firm. So for the free cash flow to the firm, we should calculate PBIT. PBIT is 192.3, it's $1,000,000. Okay, then we will deduct tax, and tax is 20%. And if we take that 20% of 192.3 into 0.2, that is 38.46. Okay, then we will add back the depreciation, that is 112. Then we will deduct the capex, and that is equal to 98.2. So the sum of all these cash flows will be FCFF 192.3 minus 38.46 plus 112 minus 98.2. It is equal to 167.64. Okay, what about the growth? Growth can be calculated by taking the difference of the latest profit after tax and the earliest profit after tax raised to power 1 over 3 minus 1. So that is equal to 91 over 83.3 raised to power 1 over 3. It is exactly equal to 3%. So the growth is equal to 3%, and the cost of capital is equal to 10%. So if we calculate the market value of business, that should be equal to 167.64 into 1.03 divided by 0.10 minus 0.03, and it will be equal to 2466.70, and the equity value is 40% of this. So let's calculate the equity value. Equity value is 40% of this value, that is 987 million dollar. Okay, we have solved the first part of C. Now calculate the combined market value of both the target and the acquirer. So let's calculate here, and if we go through this data from here to here, we will analyze that we need to make free cash flow firm performer of 4 years. Data is of million, this will be of years. So first of all, we will write the sales, and sale in first year is 4200, and it will grow with 7%. So it is 4200 and it will grow by 7%. 4494, 4809, 5145. Okay, PBIT is 20%. 4200 into 0.2, 840. 4494 into 20%, 898.8. 4809 into 20%, 961.8. 5145 into 20%, 1029. Okay, what about the tax? Tax is also 20%. 840 into 0.2, 168. 898.8 into 20%, that is 179.8. 961.8 into 20%, 192.4. 1029 into 20%, 205.8. Okay, the depreciation and the capex are same, but there is additional capex. That is for year 1 is 200, and that it will change by 0.64. 200. Then we will change the sales into 0.64. 188. 201.6. We are taking the change of sales and multiplying with 0.64. So FCFF will be equal to 840 minus 168 minus 200, 472, 898.8 minus 179.8 minus 188, 531, 961.8 minus 192.4 minus 201.6. So I'm taking the round of value, 568. 1029 minus 206 minus 215, 608. And from year 5 onwards, cash flow will increase with a growth of 5.6%. Okay, let's calculate the WACC first. Asset beta is 0.8 and 0.95. So average beta, the acquirer beta is 0.8 and its value was 12,000. If I am not wrong, it was given in the question. 12,600. And the other company value is 987. So 0.95 is the beta of F company into 987 divided by the same denominator, and it will be approximately equal to 0.811. Then regear this beta with the gearing of parent company, that is 3070. This is beta asset. We want to calculate beta equity. 70 is the equity, 30 is the debt. So the regear value is 1.09 approximately. Then calculate cost of equity. 2% is the risk-free rate plus 1.09 into 7%, it is 9.6%. And what about the WACC? 9.6% into 70% is the equity proportion, plus KD is 5.3%. Take its after tax value into proportion of the debt, that is 30%. So what is the cost of capital here? That is approximately equal to 8%. So let's discount these cash flows at 8%. 608 into 1.056, 0.08 minus 0.056, and discount factor of year 4. So the present value will be 437, 455, 451, 446. And if we discount this area, it will be approximately equal to 19,630. And the total value is market value of business, that is equal to 21419. Obviously the equity value is 21419 into 70%, and that is 14,993. That is the combined equity value. So we can write combined equity value. If we deduct the parent company value and the other company value, this will be 12,600, 987. So the total benefit will be $1407 million. This is the total benefit. Okay, we want to give some premium to the target company, and that is 30% on their value. If we take 30% of 987, approximately it will be equal to 296. So benefit for the acquirer is 1111, and that is approximately, in terms of percentage, return of approximately 9% return. Benefit in percentage, that is benefit for the acquired company shareholders. So we have calculated the first and the second part of C. Okay, now let's move to the discussion of part A, part B, C, and the last part D. So the first part was compare and contrast the reason for the opinion held by director A and B and discuss the synergy benefits which may arise from the acquisition. So what was the director A was saying? He was saying that we should acquire the other companies related to the different business areas, and director B was saying that we should acquire the other companies, but these companies should be of the same business areas. So let's just sorry, let's discuss from the standard answer. Director A focus is on reducing the risk in the business through diversification. Okay, and thereby increasing its value. A strategy of risk diversification resulting in greater value can work in situations where the equity holders are exposed to both systematic and unsystematic. But there is a debate. Majority of the shareholders, majority of shareholders diversified their position already. So they have already diversified their position. So if the company is going into the diversification, it will add no benefit for the existing shareholders. But in case where shareholders are not diversified, and if company do the diversification, then definitely it will increase the value of shareholders. So for example, when the investment is concentrated in one company, in such situation the shareholder would be subject to unsystematic, and diversification would reduce the risk. In this paragraph, we are talking about those investors which normally invest in single company. But in this scenario, this is unlikely to be the case as large proportion of shares owned by institutional shareholders, and it is likely that their investment portfolio are already well diversified. So that's why this opinion of the director A will not add any value to the wealth of the existing shareholders. Further diversification will be of no value to them. In fact, it may consider that managers are only taking this action for their own benefit, as they may be closely tied to the company and therefore he be exposed to the total risk. This may mean that become a source of agency related conflict. Yes, this will become the agency related conflict of source. Okay, however, diversification overseas into the markets which may have some barriers to entry might reduce both systematic and unsystematic risk as well. Director B, on the other hand, seems to be suggesting that company should focus on its core business and increase value through identifying area of synergy benefits. It may be the case that company management and directors are well placed to identify areas where company can gain value. So the types of synergy benefits which may arise in establishing pharmaceutical companies can include: identify undervalued company, it will give the benefit, and we will identify the company, undervalued company, it will be cheaper company, we will replace the management with our effective management, and we will then unlock the value of that company. Acquiring company which have strategic assets or products pipelines, company may be well placed to identify companies, and with those companies we will exploit their value fully because our company is fully established. So acquisition company may be able to exploit economies of scope by eliminating process duplication or economies of scale, where its size may enable it to negotiate favorable terms. Okay, Fashoro Co may benefit if company acquires it because it is struggling to raise funds for its innovative products, but our company is established, mature company, we will raise the funds and we will unlock the value of the subsidiary company. Okay, what about the second requirement? Discuss how using rail option methodology in conjunction with NPV could help establish a more accurate estimate of the potential value of companies. Look, remember one thing, whenever we do an NPV, In an investment appraisal question, we normally limit our analysis for few years, like for 3 to 4 years. You cannot digest this information that one can stop its fruitful, successful business after 4 years. This is not possible. So, what we have done in the investment appraisal analysis, we always solve our question for 4 to 5 years. But this is not practically possible. In practical situation, we normally see our business for the foreseeable future. We normally continue our business for the foreseeable future. We normally run our business um, on the concept of going concern. So what we are missing in the investment appraisal, that in investment appraisal we don't value the life after few years. We do not value this concept that if we invest in some business and if we are wait if we continue that business for 3 to 4 years, we can get new idea, we can get the new chance opportunity. After establishing one successful business, we can make it more branches, we can add the new business. Or if we have developed a skill in one business, we can establish it into a chain of business. We do not do the analysis in like this. So traditional investment appraisal methods such as NPV assume that investment need to be taken on a now or never basis, and once it is taken, it can never be reversed. Real option take into account the fact that in reality most investments have within then certain amount of flexibility, such as whether or not to undertake the investment immediately or to delay the decision. So if we have option to delay the decision, definitely it will add the value, because if environment or if the circumstances further improve, definitely it will add some value. And if we had follow on opportunities or cancel an investment opportunity after it has been undertaken, it will add some value. Where there is increasing uncertainty and risk, where a decision can be changed or delayed, this flexibility has value. Like if we open a project and in like in that area which is not suitable for the investment, but government has given some option to us that we can close the business after few years and government will fully refund our investment, definitely it will increase the worth of our project. Because if we successfully launch the project and project is progressing over the time, definitely we will ignore the government option. But if project starts failing, definitely we will accept the government option. In normal traditional methods, we don't think like this, but using the rail option, we will think like this when we study the rail option. NPV capture just the intrinsic value of the investment opportunity. Intrinsic value means the basic answer, the basic NPV. In the basic NPV means when we consider the cost and benefit. Whereas real option capture both the intrinsic value and the time value to give an overall value of the opportunity. When a company still has some time available to it before a decision need to be made, it may have opportunities to increase the intrinsic value of the investment through the strategic decision making. What is time value like? If we open a shop for 4 years and the NPV of these 4 years is $100 million, that is the intrinsic value. But what is time value? During these 4 years, we have the option to open a new shop, we have the option to expand this shop, we have the option to open a new business. So this time of 4 years while doing the business, this has some worth. So real option will consider this option. Investing in new companies with numerous potential innovative products pipelines may provide opportunities for flexibility, where decision can be delayed and intrinsic value can be increased through strategic decision and action taken by the company. So real option try to capture the value of this flexibility within companies with innovative product pipelines, whereas NPV, simple NPV does not. Okay, let's discuss the third part of the part C. Evaluate whether the acquisition of F company would be beneficial. That is beneficial. Obviously, that is 9% return for the acquired company shareholders and discuss the limitations. Okay, in this part you will make a report to from and you will give the introduction. This is the numerical discussion that the previous company value is 12,600, subsidiary value is 986. We have calculated the combined value and it will give the benefit 296 to the F company and 1,111 million for the acquired company. So this is a discussion that this acquisition will definitely give benefit to the acquired company shareholders. However, there are some limitations. Limitations are growth rate of free cash flow will remain constant for the foreseeable future. And if it changes, definitely it will change the answer. It is not explained how company cost of capital is estimated. So such an estimate may be more difficult to make for private companies. So we are assuming that this cost of capital will truly reflect the required return of the investors. The assumption of perpetuity is made when estimating the value of F company and the combined company. This may not be valid. We are assuming that company will continue for the foreseeable future, but it depends. The basis for the synergy benefits such as higher growth, profit margin need to be explained and justified. Why we are taking 20%, why there is a growth of 5.6% for the foreseeable future. It is not clear here, but we are assuming. Whereas it may be possible to estimate the asset beta of the listed companies, it may be difficult to calculate the asset beta of the private company, but we are assuming that this data is reliable. The cost related to the acquisition would need to be factored in. Here we are considering the acquisition of Fisher & Co, but we are ignoring the cost incurred in order to acquire the other company, the cost of involving investment bank, valuation cost, and the etc. The valuation indicate that company shareholder would benefit from the acquisition of Fisher & Co and the value of their share would increase by 9%. However, the method used to estimate the value created makes a number of estimates and assumptions. It is therefore recommended that range of valuation is made under different assumptions and estimate through a process of sensitivity analysis before a final decision is made. So remember one thing, whenever you are discussing anything of the estimates, you will add this line that you should do the sensitivity analysis in order to increase the reliability of the answer, as well as limitation of the evaluation method should be used, be well understood and taken into account. Okay, this is appendices, all the calculation stuff. Okay, let's discuss the last point in which we have to discuss the mandatory bid rule, principle of equal treatment, then the two defenses. One defense was disposal of crown jewel and poison pill. Mandatory bid rule and principle of equal treatment are designed to protect minority shareholders. Where an acquirer has obtained a controlling interest of the target company, mandatory bid rule provides minority shareholder with the opportunity to sell their shares and exit the target company at a specified fair share price. Like in UK, there is a rule that if you acquire the 30% of the other company, it is mandatory for you to bid the remaining 70% shareholders and at a price which is not less than the previous higher price. This price should not be lower than the highest price paid for the shares which have already been acquired within a specific time period. The principle of equal treatment requires the acquiring company to offer the same terms to the minority shareholder as were offered to the earlier shareholders from whom the controlling interest was acquired. Both these regulatory devices are designed to ensure that minority shareholders are protected financially and not exploited by the acquirer. Okay, now we are going to discuss poison pill and the crown jewel. Purpose of poison pill and crown jewel is to make the target company unattractive for the acquirer. What is poison pill? Poison pill is like, this is the target company and you are the predator. If you acquire 20% of this company, target company will issue more shares at discount to its remaining loyal shareholders. So percentage holding of these shareholder will increase and your will decrease. but company will issue these shares at a substantial discount to these shareholders, and that substantial discount will create a poison pill. Poison pill gave existing shareholder in the target company the right to buy additional shares in their company at a discount once the acquiring company has bought a certain number of shares in the target company. The aim is to make the target company more expensive to purchase as the acquirer need to buy more shares. What is crown jewel? Crown jewel involves selling the target company most valuable asset, therefore making the target company less attractive. The effectiveness of these defense tactics can be limited as the company management would need to get the shareholder approval. Shareholder may not be willing to do this as they normally get premiums on their shares during takeover battles. Additionally, disposal of key assets could substantially weaken a company comparative edge, therefore its future potential. Such action may be detrimental to the company and therefore shareholder would probably not approve that course of action. They will suggest some other actions in order to protect the company, or if the offer is better, definitely they will accept the offer. So that is all from the discussion of this question. If you have any question, you can email me at this email. Thank you so much, guys.